If not quantitative easing, then what alternatives to quantitative easing? That's what we're going to talk about in this video. Whenever there's a financial crisis, we always seem to hear the same thing. Quantitative easing, central bank pumps money into the system by buying bonds, and the headlines scream money printing. But QE isn't the only tool out there. In fact, economists have debated plenty of alternatives, some safer, some riskier, and some controversial. In this video, we'll explore the most talked about alternatives to quantitative easing and whether they could actually work. Traditional tool, I would say fiscal policy. One alternative is fiscal policy, and that's when governments, not central banks, stimulate the economy through spending and taxation. Instead of printing money to buy government bonds, governments can fund infrastructure, cut taxes, or directly support households. The idea, put money straight into the hands of the people and businesses that will actually spend it. The difference is important. QE tends to boost asset prices, which mainly benefit investors. Fiscal policy can target real economic activity like jobs, roads, healthcare, with a more direct impact on everyday life, is probably how I would sum it up. Negative interest rates. Whew. Okay, it's a controversial one. Another alternative, though controversial, like I said, is negative interest rates. Some European countries and Japan have tried this. Here's how it works. Instead of earning money on your savings, banks actually charge you to hold deposits. Sounds crazy, right? But the goal is to push people and companies to spend or invest rather than hoard cash. While it hasn't been a magic bullet, it shows central banks are willing to experiment beyond QE, quantitative easing, so I guess that is a positive. Another option is direct cash to citizens, and this is called helicopter money. That's a funny name actually. So here's the idea of helicopter money, literally giving cash directly to citizens. Instead of going through banks and bond markets, central banks could just send everyone a check. This idea gained traction during COVID, when governments mailed out stimulus checks. While technically that was fiscal policy, some economists argue central banks could do the same thing in extreme cases. The benefit, it goes straight into people's wallet, boosting spending right away. The risk, it could fuel runaway inflation if not carefully controlled. So that's some of the ideas that have been put out there, and while QE has become the go-to solution for crises, it's far from the only option. Governments can use fiscal policy, central banks can experiment with negative rates, and in theory they could even drop helicopter money straight into your bank account. The real question is, which tool is smartest and which one creates fewer long-term risks? If you found this breakdown useful, hit the like button, hit subscribe for more plain English explanations of money and markets, and let me know in the comments what you think. Do you think central banks should move beyond QE, or is it still the best tool we've got? You can also drop us an email at info@expatmoneychat. And again, thank you for watching, much appreciated. Cheers.